Hi, it's Blake Davenport with the Davenport Group of Long and Foster bringing you this week's real estate tip of the week. This week we're going to be talking about how much money or how big should your down payment be. It's a common question that I get asked, so I thought it would be appropriate for this week's real estate tip of the week. So let's jump in. So first, what is a down payment? A down payment is an upfront payment that you make when you purchase a home. So it's actually money that you're taking from a savings account or brokerage account and you're putting it towards the purchase price. Say a purchase price is $500,000 and you're putting 10% down, so you're putting $50,000 down. So you're really getting a loan for that additional 90%, which is $450,000. As I said, a common question is, well, how much do I need? I hear that, I need 20%. No, that could be further from the truth. Because home prices are so expensive in the DC metro area, it's very uncommon that, you have 20%. Most people have less. There is some pros and cons to having more money or 20% down. Typically, people don't put more than 30, but some people pay all cash. It just depends. What I recommend is, there are loan programs for everybody and, different people in financial situations. So what I recommend is to talk to a lender. They'll be able to give you the idea of what realistically you can afford and what you should put down. But, I have helped people put 0% down. I've helped people put 3% down. I've helped people put 40% down, or all cash. What I would typically recommend is you should have at least 3% down. That will be a conventional loan. Anything below that won't be conventional, so your interest rate is going to be much higher. And then as you start to put more money down, you're going to get a slightly better interest rate. And then the other bigger factor is the more money you put down, the lower your monthly payment will be. So I think that's very important too, is understanding what monthly payment do you feel comfortable with. Because, while maybe you could put 10% down, but you want to save the money for in case something comes up, or you want to invest it because the interest rates are really low. Maybe you look at 5% and you say, well, what's the monthly payment at this versus 10%? I think that's very important. So I would say, you should have at least 3%. 5 is really good. You're going to get a better interest rate at 10. The difference between like 10 and 20, could make a difference. If you're under 20%, most lenders were going to charge you PMI or private mortgage insurance. I have another real estate tip on that, so look out for that video. But again, why you should talk to multiple lenders when shopping for a mortgage. A lot of lenders, they have loan programs that are lender paid PMI. So instead of a 4% interest rate, you get 4.125 or 4.25, and the PMI is reduced. So if you can do that and avoid PMI, then you don't necessarily need to put 20%. So a lot of people don't realize that you don't need as much money as you think. It just greatly affects the monthly payment. And obviously, if you want to afford more, you want to afford $1 million house, you might have to put a certain down payment to qualify. So it just really depends situation by situation. But that's why I would highly recommend talking to a lender, and they could run the numbers for you. But you don't need that, that whopping 20% to buy a home. Really, I would say 3%. And then also factor the closing costs, which are about, 2.5%. And again, I have another video on that. If you'd like to learn more about the mortgage process, click the link below. I have a mortgage 101 guide that kind of goes in depth of all these different topics. Plus, I do a lot of tips on the mortgage process because I think it's very important, and I'm a numbers driven person, so I find it very interesting. I think that's where you can save a lot of money in the home buying process. But again, thanks for tuning in to this week's real estate tip of the week. Bye bye.